The Firm, India's only show on corporate law, tax and audit matters.
Welcome back. This is The Firm. 2015 was a record year for M&A activity. Deals worth $5 trillion were done. That's a 37% increase over 2014. Now, of them, there were 69 deals that were worth $10 billion and more each, totaling $1.9 trillion. And of them, 10 deals were worth more than $50 billion each. Healthcare was the most deal-active industry. In fact, the $160 billion Pfizer Allergan deal announced in November is the biggest deal in healthcare ever. It's also the second largest M&A deal on record. Investment bank Moelis and Co. is an advisor to that deal, and CEO Ken Moelis is in India and on The Firm this week. I began by asking him what drove that heightened deal activity last year.
Look, I continue to believe corporations around the world are struggling with a very low growth environment. The reason you had such large scale mergers happen is people are trying to take costs out. A lot of these mergers are centered around cost synergies. And I think in order to get costs to be meaningful, you usually end up merging with a substantial company, a company pretty close to your own size so that the cost reductions are meaningful. And I think that's why you saw so many large transactions last year.
I think these are the sort of record numbers for large transactions. You've spoken of this deflation trend being the M&A trend. Is that what explains the inversion trend as well?
Most people of my generation who are running companies have always thought inflation was going to be their problem. And for the first time in a long time, they are dealing with deflation. And what happens in a deflation, you have to take every cost out. You have to deleverage, you have to get your costs down. So the first thing you get down is your SG&A, then you get down your cost of goods sold, and the last line item of costs to be taken out is taxes. So when people look at inversions, the reason inversions are showing up today is companies have to get every cost out, and taxes are a cost.
Okay, before I come to inversions, how successful in your experience have deals that are focused on reducing costs been?
Well, that's hard to say. Believe me, every one of these transactions in which cost has an element has a strategic element. You no longer see people merging outside of their sector. So the conglomeration that used to go on in the 90s a little bit, I call it growth at any cost. So the 90s were a decade where M&A was all about growth. Growth at any cost. I mean, if you think back to the day of the finality of that might have been the Time Warner AOL merger, in which there was growth but no cost synergy. I do think the cost synergistic merger is a much lower risk merger. And the market is telling you that. The market is saying, more often than I've ever seen, the acquirer stock in the last year or 2 years has gone up when they announce a merger. Now, 20 years prior to that, it almost never happened.
Okay, I'm going to focus on healthcare because that's also where you're doing the marquee deal of this year. It's a tax inversion. Inversions haven't got very good press in the recent past. I know you don't talk specific to a particular deal, but I do want you to tell me if you think this trend of companies moving their headquarters outside the United States of America is here to stay.
Well, again, I'm not going to speak to a specific deal.
I
never speak about our clients. But what I will say is I think a corporation has every right to look at every cost it could possibly look at and put their company in the best place to deliver value to shareholders. So people choose cities to work in, they choose their real estate they'll work in, and I think they have a right to, if they can, choose a tax jurisdiction that is more flexible. It's not only rate, by the way. There's flexibility in some of these tax jurisdictions to move cash around the world. And I do think that if the U.S. wants to maintain the corporate activity in the United States, they should take action by law and reduce the tax rates of U.S. corporations. We have too high a tax rate. It's obvious, and there's a very simple way to stop inversions: lower the corporate tax rate.
So I'm guessing then you don't view very favorably the actions taken by the White House to try and block or limit tax inversions. And in fact, it's now become a debate point or a talking point in the elections as well.
Look, there's almost no way to stop things by decree. I think there was a famous king who once tried to stop the waves from coming in, and they kept coming. But there's no way to stop corporations from seeking out ways to maximize the activities they're going to do. By the way, the employees benefit. When a corporation lowers its tax rate or finds a more optimal place to do business, everybody benefits. They're able to make goods cheaper. So the right thing to do, there's one right thing to do. The United States has to get together and figure out a way to make it attractive. We used to be the beacon of capitalism for the world, and we must figure out a way to make sure that it's the best place to do business in the world, and we should.
Okay, so Hillary Clinton, I think, said in one of her election speeches that she has a detailed and targeted plan to immediately put a stop to inversions and place an exit tax on corporations. Now, look, so much of this could just be campaign speaking. But if that were to come about, that would deliver a body blow to the M&A business in the US.
I think it would deliver a body blow to free markets in the US. Look what we're talking about. We're talking about a presidential candidate talking about putting a cage around United States corporations and locking it and putting an exit tax. Is this the United States? This is not what I think of as free markets. And free markets is the driving force that made the United States what it is today. So these, I hope they're campaign slogans, because this is not the country that is the most innovative and aggressive at creating value in corporate world that I remember.
We've had an awful beginning to the year. Global markets have been down across the board. What is your outlook for M&A in 2016, especially given how nervous equity markets seem to be?
So interestingly, the amount of conversations that I believe are going on right now regarding M&A, spin-offs, corporate structuring, things we're involved in, are as large as they've ever been. There is no diminution in the amount of conversations as people try to figure out how to move their businesses forward. Now, that's not to say that if the markets continue with the volatility we saw last week, where 500-point swings in the Dow Jones average in a day, well, it was really 1,000. I think it went up and down, 500. If you have that kind of volatility, will that affect the ability to structure transactions? Yes, obviously. But as of now, I believe everybody is still very much on their front foot trying to figure out, how can I use M&A to improve my business?
And is it still the hunt for lowering costs? Or are you now seeing companies a little worried about the reduced demand across the world and looking at deals that help the top line more than anything else?
But that goes hand in hand. So top line is very difficult. There are not many sectors in the world right now that have pricing power, that have growth. I think one of the things people are very much underestimating has been the lack of growth out of the US economy. There's a lot of focus on China when they missed by a point on their GDP, but the US has missed by a point for a couple of years, and that's a large point of growth in the global economy given the size of the US economy. So I think, again, this is, when you say reduce costs, they are putting businesses together that improve the top line. But growth is still very hard to come by, and I think you're going to see, this is what I talk about on deflation, you're going to see pricing power continue to be very difficult.
If you were to forecast trends that would dominate M&A in the years to come, what would they be? It could be country trends, it could be, for instance, cost strategies, as you spoke of. Any hint of what the future holds for us, or is it too volatile to say right now?
No, I get asked what sector, and the interesting part is I believe the deflationary impact of the world is going across all sectors. It's driven by technology. What Amazon is doing to a retailer, what Uber is doing to logistics, what Airbnb is doing to the lodging industry, what fracking has done to oil. And interesting, fracking is a new technology. It's not a new oil field. It was a new technology that drove down the price. So what technology is doing to the ability of people to get more value, I'm talking about the consumer. The consumer is able to see price transparency, selection, and dictate much more to the producer. And so, look, I think that's going across all industries. And so this M&A is not a sector M&A. It is actually just a theme based around, I think, deflation and low revenue growth.
Well, that was deal maker Ken Moelis. With that, we've got to wrap it up here on The Firm. Thanks very much for watching. We'll see you next week.
The Firm, India's only show on corporate law, tax and audit matters.